Data shows that despite high inflation, Americans have not pulled back on their spending in January on the back of a strong labor market. It may be a sign of economic recovery, but it could also indicate more rate hikes ahead as strong demand could push up prices further. Eun-jin explains.
U.S. retail sales saw the biggest increase in nearly 2 years in January after 2 straight months of decline. The Department of Commerce reported on Wednesday that advanced retail sales for the month increased 3%, higher than the expected 1.9%. American consumers spent more on vehicles, furniture, clothing, and dining out. Motor vehicle and parts dealers saw retail sales increase 5.9%, while sales at service stations remained stable despite a 2.4% increase in gas prices. Home furnishing stores saw a 4.4% rise, online retailers 1.3%, electronics and appliances stores recorded a 3.5% increase, and food services were up 7.2%. No category saw a decline. The underlying trend in consumption is that Americans are indeed spending. On top of climbing credit card debt, the boost in retail sales in January is being driven by 2 significant factors. The biggest cost of living adjustment since 1981 went into effect in January, meaning Social Security checks increased 8.7% for more than 65 million recipients. Job growth also surged at the start of the year. According to Labor Department data released earlier this month, the unemployment rate reached a 53-year low as employers added more than 500,000 jobs at the beginning of the year. Experts highlight that though consumption is indeed not as weak as December figures might have indicated, it is not yet as strong as the January numbers suggest. Inflation remains persistent, and the fear of a recession is not completely out of the picture, though not imminent. The Fed will continue to move monetary policy as slated, with quarter percentage point interest rate hikes at each of its next 2 meetings. Eun-jin, Arirang News.